money for them in these holdings companies like property shares, the whole gamut, right? They're quite gung-ho and super excited about the benefits and how they're not going to have to pay tax in their higher marginal tax rate. They're going to cap tax at 30%. But just from talking to you the other day, there's some things that they probably should be aware of that they're not, so they can go into this holdings company investment strategy with eyes wide open.
The main thing to consider with holding companies and bucket companies when they're investing their money, particularly in growth assets, is that the capital gain when they sell that investment is not subject to the same capital gains discounts individuals and trusts are allowed. And the reason is because companies generally have a capped flat rate of tax, so they've already got a concessional rate. So when it comes time to sell, they're not subject to those same CGT discounts.
But if they hold it in their personal names, obviously they're going to get the 50% discount. Say they hold an asset for 10 years, just to really use simple numbers. They have a $500,000 property, $500,000 worth of debt. That property doubles in value, so there's a $500,000 gain. Obviously, held personally, they're going to get the 50% discount. Then that gain will be distributed into their personal names, depending on the structure there. Then they'll pay tax on it. Whereas in the holdings company, that will be capped at 30%. So it's a little bit unclear on whether or not it's going to be advantageous depending on their situation, right?
And depending on what their marginal tax rate's going to be. Essentially in the year that they do sell, which could be 10, 20 years down the track, it's really unknown as to what their situation is going to be. So having the flexibility when you've got the holding company or a bucket company owning that property is that you can hold it for the long term, and then when you do come time to sell, those shareholders and beneficiaries might be in a low income position because they might have retired, or they might have adult children who have just turned 18 and they're now what you would call eligible beneficiaries. So there's lots of different ways in order to get property cash out tax effectively through